There was a time when our great FIIs, foreign institutional investors, they used to come, market used to go up, they go out, market used to fall. Now I think that is not happening anymore. Now as on date, I think FII holding in Indian equities is the lowest, correct, right? So how exactly these FIIs are looking at Indian market? Today majority of the investment in Indian market is by Indian investors. FIIs are holding around 17-18% if I am not wrong, you correct me there. So but FII, which is a really elephant, how exactly they are looking at Indian market, Indian companies, Indian economy? What are all the parameters they generally look at to come back? Whether they will come back now or why they really went out? I think there are multiple questions here. If I miss, I will ask this once again.
Sure. Before answering the questions that you raised, we should also remember that the dominance of FIIs in terms of Indian market movements has reduced considerably, which you also alluded when you asked that question.
Correct.
Maybe I'll spend 2 minutes to explain why it has happened.
Okay.
At a point of time in the past, they used to hold almost a quarter of our equity capital.
25%?
25%.
Okay.
And also in terms of our flows, annual inflows or outflows used to be much higher than what we used to see from the domestic investors. Whether through directly or through mutual funds or life insurance company.
Yeah.
So to that extent, not only they held a large chunk of Indian equities, they also moved the markets because their flows were very, very dominating. Now that situation has changed. As you rightly said, they are at about 17-18%. Indian institutional investors also hold more or less similar amount. And in terms of flows, in fact, the domestic flows have overtaken the foreign flows at this point of time. So to that extent, the balance has shifted away from foreigners and it's become more balanced. And also the third thing that we need to remember is, in the last 5-7 years, we have got a new category
of investors.
Category of investors who are liking products like dynamic asset allocation or balance advantage or any of the hybrid funds, where the equity allocation goes up or down based on the valuations. Right. So now there is a large pool of money that is in these categories, and even if you assume that there are no new flows coming into the mutual fund industry, hypothetically let's assume that market falls 15 or 20%, the valuations become cheaper and the money could move from fixed income to equities. So that is also providing a lot of cushion to market movements.
That is very sizable money, is it?
Sizable amount. It's close to about 3.5 lakh crores in the entire category. Big number. And it not only reduces volatility at the lower end, it also reduces volatility at the upper end, because as equity becomes expensive, it will move towards fixed income. So this has changed the entire market structure, and that's why the foreign money is not the only critical part that is driving the market.
Indian market,
Now coming to your question, how do you see FIIs reacting going ahead? First of all, we need to remember that it's not a homogeneous pool of investors. Starting from high frequency traders who trade in microseconds and seconds, there are also investors who take a 20-year, 30-year, 40-year kind of a call. For example, sovereign funds or pension funds or really long-term funds. So you have the entire spectrum of investors, even from foreign institutional investor side. What you see is only the net number that you see from that pool of investors. It could be coming from any of these investors or anything in between also. So overall, if you look at today, yes, the interest in India has not been as strong as what it used to be in the past. Could be because of multiple reasons, but one clear factor could be India was always expensive relative to other markets where the foreign investors could actually make a choice. The average premium that Indian equities used to trade compared to MSCI emerging market basket used to be about 40 to 45% premium. And now that premium has moved towards that 70% or above. So to that extent, whenever an investor looks at purely valuations, there will be investors who look at long-term growth story and who will still come and invest. But there could be some investors who look at purely valuations. Maybe those are the ones who are not coming to India at this point of time. So at the end of the day, if India continues to deliver this kind of economic growth and corporate earnings. At some point of time, hopefully the valuations will also become reasonable, and then you can expect more FII
Flow
money
to come in.
And one more thing that we need to remember is India currently is about 20% of MSCI emerging market index.
20%, yeah.
Nobody can ignore India. Maybe
It
20
was
years.
what, around 8% at one point of time?
It was even lower than
Lower,
that.
okay.
So 15, 20 years back, it used to be very, very small number.
Oh, okay.
So at that point of time, one could ignore India, and even if India had gone up significantly, it wouldn't have impacted the portfolio performance.
Change nahi hota.
But now at 20%, it can't be ignored. And also, the other factor is China, Taiwan, and Korea. 3 other competing emerging market countries collectively have 55% weight in the index.
Okay.
So the question is whether the incremental $55 for every $100 that you receive will go into these markets.
Correct.
Because these are mostly export dependent countries.
Yeah.
And as of now, the global growth continues to be very, very sluggish, much below what domestic growth rate for India has been.
Correct.
And India is not as export dependent as some of these countries. So at least in the next few years, India is likely to be more resilient in terms of economic growth, and hopefully the valuation should also get adjusted and we should expect more money coming from those investors as well.
Okay. One more adding to this, US interest rate has moved from what, around less than 1% to today we are at around 5% kind of that. Now it has come back a little bit. Even that interest rate, that is Fed interest rate, has gone up. Whether for that reason also money has gone back and it is thinking that risk-free return in US itself is much better than riskier assets in the other part of the world, whether that argument is also there?
It is possible, but I don't think that's the only driver for all the investments. For example, there are funds which can invest only in equities, and those equity funds globally, then they will look at available opportunities within equities. They don't move from equities to fixed income. But there could be some hybrid funds or where the decision could have been made from one asset class to another. There is a possibility that some of that money has gone to other markets and other asset classes. But by and large, I don't think we need to be worried about some of these events and see how it's going to impact. As I said, in the current context, I don't think we are dependent only on FII money. That's point number one. Second, it is also as cyclical as any other investor group. So there will be periods where you will see inflows, there will be periods where you see outflows. But when you look at India and compare it to what's happening in the globe, and also the fact that India has a significant share of emerging market basket in terms of the weightage, it's very, very difficult to assume that over the next 3-5 years, the flows are going to be as tepid as what you are seeing today. Definitely it has to be much higher than where we are currently.
So valuation is one factor which some money is waiting to come, and definitely, as you said, we are already 20% of this particular index. Sooner or later money has to come to India.
That's right.